The CME and its four subsidiaries, NYMEX, COMEX, CBOT, and CME itself, together form the largest futures exchange in the world. For several years now, the exchange has been publishing the so-called SPAN framework daily and free of charge for everyone. The CME SPAN method is continuously improved and further developed and can be used to assess risk for the widest possible range of derivative and physical instruments. Although originally designed for use with derivatives, its exceptional capabilities have led to widespread use in the risk assessment of many different types of financial instruments. As the industry standard for portfolio risk assessment, the CME SPAN methodology is the official margin mechanism for more than 50 registered exchanges, clearinghouses, service bureaus, and regulatory organizations worldwide. CME SPAN software is used by a wide variety of end users, including futures commissions merchants, investment banks, hedge funds, research organizations, risk managers, brokerage firms, and individual investors worldwide. The CME SPAN methodology assesses overall portfolio risk by calculating the worst-case loss that could realistically occur in any portfolio or derivatives and physical instruments over a given period of time, typically a trading day. It does this by calculating the profits and losses the portfolio would incur under various market conditions. At the core of the methodology is the CME SPAN risk array, a series of numerical values that indicate how a given contract will increase or decrease in value under various conditions. Each condition is referred to as a risk scenario. The numerical value for each risk scenario represents the profit or loss that a given contract will experience for a given combination of price change or underlying price, volatility change, and decrease in remaining time to expiration. Simply put, the CME recommends to companies such as brokers or clearing firms the dollar margin amount that their customers should hold in their account to trade. For example, one ES futures contract. A number of different factors are included in this calculation. Since numerous institutional trading parties use this value to calculate their own risk, the SPAN value can be used to simulate the price movement of the underlying that would put these institutional traders under pressure and confront them with margin calls. This SPAN interval is recalculated daily from the close of the previous day's electronic trading session. It offers us several advantages. First, we can view the SPAN interval prices as strong supports and resistances, since institutional traders will naturally be keen to keep the price within the SPAN price range, in which they will not come under pressure. On the other hand, the SPAN interval has another major benefit. Within the SPAN levels, the price usually behaves much more calmly and predictably. Levels hold better and are almost always respected by the market in one way or another. So, to a certain extent, the market behaves rationally. However, if the price breaks out of one of the SPAN levels, either upwards or downwards, things can get wild. The market usually picks up speed, becomes more volatile, more unpredictable, and rushes through our levels without regard for them. For this reason, we only plot our levels up to a maximum of twice the SPAN interval. We do not want to open any new trades outside of this price range. We also recommend to many of our customers, especially beginners, to focus exclusively on trades within the SPAN interval.